Good day, everyone, and welcome to another edition of Friar Financial's Financial Forum. Spring is in the air, kind of, sort of. At least in North Carolina, we're a little up and down still. Hot, cold, cold, hot. And excuse Jeffrey and I as we both are battling pollen that looks like it is snowing around here in North Carolina.
Mm.
So we're both sounding a little probably groggy today, but bear with us. We'll get through the session today. Today we're going to talk about in our Wealth Wisdom workshop how to future proof your finances in these uncertain times. So give you again some step by step things to kind of look at as you're trying to navigate this financial environment that we're currently in. So without further ado, we will begin with our first section, markets in motion. All right, so let's take our time a little bit with this one, because the story of the markets this week wasn't a straight line. It was more like a shift in mood that unfolded day by day. So we started the week with a sense of cautious optimism. Excuse me. Stocks opened higher for the week. Um, and for a moment, it felt like the market was kind of like exhaling. The White House then came in, described that ceasefire conversations were very good and productive, and that alone helped ease some of the tension that had been building up. Add to that the absence of any new developments around Iraq's force majeure declaration, and you had a market that was really ready, maybe even a little bit eager to latch on to some of that positive news. And it did. The Dow and S&P 500 logged their best day since early February. It was one of those days where you could almost feel investors saying, okay, maybe we're turning a corner here. But as the week unfolded, that optimism didn't quite hold up. Tuesday brought renewed pressure. Not a dramatic sell off, but enough to remind everyone that the underlying uncertainty hadn't really gone anywhere. Then midweek, we got a rebound. Reports surfaced that Pakistan was mediating ceasefire talks, and that gave markets a lift. All three major indices posted solid gains that day. But even then, you could still see a little bit of hesitation. Retail investors weren't rushing back in. It was more like the market was trying to find its footing, but wasn't fully convinced. So dip a toe in, take it out of the water. Dip an ankle in, take it back out of the water, kind of that thing. And then Thursday and Friday just changed the tone entirely. Even after the White House extended its pause on military strikes on Iranian energy infrastructure, something that normally would have calmed the markets, the pressure didn't let up. By Friday, selling picked up. The Nasdaq and the Dow both slipped into correction territory again, and the S&P notched its longest weekly losing streak in almost 4 years. So what we saw really wasn't panic, but it was just fatigue. We're all just tired. We are tired. We we have rebalanced accounts almost what 3 times last 10 days. So
Mhm.
yeah, we're all kind of working really hard here. And it was the market kind of saying we need some clarity before we can move forward. And that's a different kind of volatility. It's quieter, but it's persistent.
Mhm. Yeah, and what stood out to me was how the narrative shifted from day-to-day headlines to bigger structural questions. So earlier in the week, investors were reacting to the ceasefire updates, but by the end of the week, the conversation has shifted to economic implications of a prolonged conflict. And people were asking, what does this mean for energy markets, for supply chains, for inflation, for corporate earnings, all that type of stuff. And then from there, the questions just got bigger. So the markets got more cautious in return. One thing that really caught my attention was the rotation in the energy. When you have 19 energy stocks in the S&P 500 hitting 52-week highs in the middle of a volatile week, that tells you something. And it tells you investors are looking for stability, or at least sectors that benefit from the current environment. Energy became kind of a safe harbor, not because it's risk free, but because the geopolitical backdrop made it feel more predictable than tech or consumer
Mhm.
discretionary. Uh-huh. And then that's the part where people sometimes miss, I think. And then, but volatility, I can't say that word all of a sudden. Volatility doesn't just move markets up and down. It moves money around. It reshapes leadership and changes what investors value. And this week was a perfect example of that. So,
Exactly. And that's why. with anything, context matters, right?
Mhm.
The Jordan LeBron debate, sometimes you only get
Mhm.
part of the statistics. So
Exactly.
this so this wasn't a week defined by panic. It was more a week defined by recalibration, let's say. Investors weren't running for the exits, but they were kind of reassessing what was going on. And in an environment like that, having a long-term plan becomes your anchor. It keeps you grounded when the narrative shifts, and it keeps you from reacting emotionally to every headline. So that'll wrap up our markets in motion section. And after the break, we'll be back to talk about finance in focus.
Long-term care isn't a fringe scenario. It's not rare. For most retirees, it's a statistically likely event, and one that can reshape finances, family dynamics, and long-term independence. The emotional impact is real. The financial impact can be devastating. That's why Friar Financial builds retirement income strategies that prepare for the realities of long-term care, not the wishful thinking. Because planning ahead protects more than money, it protects dignity.
Okay, we're back from break to begin our finance and focus segment. And now let's look ahead because the next week is packed with economic data. And not just the routine kind that we usually see. This is the kind of week that gives us the broad, almost panoramic view of the economy. So we start with the New York Fed president, John Williams. And while it's easy to overlook Fed speeches, they do matter, especially right now. Investors are trying to understand how the Fed is thinking about inflation, growth, and the timing of future policy decisions. Even subtle shifts in the tone can influence expectations. Um, then Tuesday brings a trio of important indicators. So we got the S&P, Case-Shiller Home Price Index, the consumer confidence, and job openings. That's housing, sentiment, and labor, the three pillars of the consumer economy. So home prices are going to tell us how tight the housing market remains. Consumer confidence tells us how people feel about their financial situation. And then job openings gives us a sense of how strong demand for labor still is, where we're at currently in the economy. So, but Wednesday is a real heavyweight. We get retail sales, the ADP employment report, business inventories, PMI manufacturing, ISM manufacturing, and a petroleum status report. So a whole lot of the big dogs. And then a full economic checkup in one day. Yeah, so all in that one day, that's a lot. Retail sales shows how consumers are spending. Manufacturing data gives us insight into production and supply chains. And then the energy reports, those help us understand demand and inventory levels, especially important given the geopolitical backdrop. So Thursday, that keeps the momentum going for us with weekly jobless claims, the trade deficit, factories, factory orders, and motor vehicle sales. And then the Fed's balance sheet update as well. None of these individually move markets the way jobs or inflation data do, but together they paint a full picture of the economic momentum. And then Friday, we wrap it all up with the employment report and then the PMI services. Job reports is always a market mover, especially in an environment where investors are trying to understand how long the Fed will keep policy restrictive. So a lot this week.
Yeah. And what I appreciate about weeks like this is that they give us a chance to kind of zoom out. When you
Hmm.
get this much data in a short window, you start to see these patterns. And so now it's not just noise, you can see the pattern. So you start to understand how consumers are behaving. You start to understand how the businesses are responding. You start to understand how the labor market is evolving. And all of those are important because markets don't move on data alone, they move on interpretation, they move on expectations, they move on how investors connect the dots. And when we've got earnings coming from just two people this week, really, Nike and McCormick, two companies that in very different ways give us insight into consumer behavior. Nike tells us about discretionary spending, brand loyalty, and global demand. McCormick tells us about everyday spending, grocery trends, and how are households navigating inflation. So the week ahead isn't just busy, it's revealing. It's that kind of week that helps shape the next chapter of market sentiment.
Exactly. And I mean, the key is not to get lost in the day-to-day reactions. Data comes out every day. Markets are going to react every day. But your financial plan is built for seasons and not headlines. That's what will continue to help you navigate. So it's those seasons.
Absolutely. Great. So this will wrap up our second segment, Finance in Focus. And after the break, we will be back with the Wealth Wisdom Workshop.
People are living longer than ever, and that's a blessing. But for retirees, it also creates one of the most overlooked financial dangers, longevity risk. When your money has to last 25, 30, even 40 years, every other retirement risk becomes amplified. Market downturns, inflation, healthcare costs, they all hit harder when your timeline stretches. At Friar Financial, our dynamic retirement income strategy is built to help your money last as long as you do.
Welcome back to the Wealth Wisdom Workshop. So today we're diving into a topic that comes up every time markets get choppy or unpredictable. How to future-proof your finances when you can't see ahead, right? Because here's the truth, markets can move very quickly. You can have weeks of volatility followed by a sudden burst of strong performance. And while those gains feel good, they also stir up a little bit of anxiety. People start wondering, is the market overheating? Will these highs hold up? Should I be doing something right now to protect what I've built? When this uncertainty lingers, whether it's inflation, interest rates, global events, or just the natural rhythm of the market, the smartest thing that you can do is reinforce your financial foundation. Preparation and adaptability create confidence. And today we're going to walk through practical steps that you can take to protect your progress and stay ready for whatever comes next.
And what I love personally about this conversation is that none of these steps require predicting the market. They're not about timing. They're not about reacting emotionally. They're about building resilience. And the kind of resilience that carries you through the ups and downs and everything between. So let's go ahead and jump in.
All right. So first we want to boost those emergency savings. So let's start. That's the cornerstone of financial stability, your emergency fund. This is the buffer between you and life's surprises, job loss, medical bills, car repairs, and just other unexpected expenses. And during uncertain markets, that buffer becomes even more important. Now, we often talk about the goal being 3 to 6 months of expenses, but I want to emphasize something. The goal is direction, not perfection. If you're starting from scratch, even $500 or $1,000 is a meaningful milestone. That's a real safety net. That's a real difference maker. The key is automation. Set up a recurring transfer weekly, biweekly, monthly, whatever fits your rhythm. When you automate it, you remove the emotional friction. You're paying yourself first, consistently, quietly, and without having to think about it. And here's the part that people forget. Your emergency fund should evolve with your life. New baby, new home, new job, higher expenses, revisit your target. Future proofing isn't a one time decision, it's a rhythm of checking in and adjusting as life changes.
hmm And now let's talk about debt, especially high interest debt, because I think as much as saving does, nothing kind of erodes that financial progress faster than carrying balances at 18% or 22% interest. You can be doing everything right in your investments accounts, but if you got high interest credit card debt, it's like trying to fill a bucket with a hole in the bottom. The strategy here is simple and steady. Pay more than the minimum whenever you can. Even small extra payments compound over time. And if refinancing or consolidating lowers your total costs, explore it, especially if it simplifies your payments or reduces interest. And during uncertain markets, be cautious about taking on new discretionary debt. This isn't the season to finance lifestyle upgrades or stretch your budget. This is the season to tighten the bolts, reduce the leaks, and then strengthen your financial structure. Debt management isn't glamorous by any means, but it's one of the most powerful ways to future-proof your finances. Every dollar interest you avoid is a dollar that stays in your pocket. So, and a dollar that can be redirected towards your other goals too. So, keeping that money in your pocket is important.
Absolutely. And just to piggyback on that, understand the two methods, the avalanche method and the
hmm
snowball method um, of ways. Generally speaking, you want to attack the highest credit card debt in dollar value and the highest interest rate because those are the ones costing you the most money. So attack those first.
Mm-hmm.
All right, next we want to lock in and diversify any gains we have. So we're going to shift over to investments now. So when markets run up quickly, people often feel two competing emotions, right? Excitement and fear. Excitement because their accounts are growing. Fear because they're wondering, is this sustainable? So this is where rebalancing comes in, becomes your best friend. Rebalancing is simply bringing your portfolio back into its intended mix. If one area has grown sharply, it may now represent a larger portion of your portfolio than you intended. So rebalancing locks in some of those gains and redistributes them into areas that may now be underweighted. And here's the beauty. It's not market timing. This is just discipline. It's alignment. It's staying true to your long-term plan. Sometimes rebalancing doesn't even require selling. You can direct new contributions into the areas that need more weight. It's a quiet, steady way to reduce risk if markets cool down. And before making any moves, talk to a financial professional. Taxes matter. Timing matters. Your goals matter. Future proofing is about thoughtful adjustments, not emotional reactions.
Mm-hmm. Yep, well said. Then that kind of leads us into separating your essentials from your lifestyle spending. So I think one of the most underrated tools in financial planning is clarity, specifically clarity around what you must spend versus what you choose to spend. When times get uncertain, knowing your essential number and the amount required to keep your household running is incredibly empowering. I can't say that enough. Essentials are the things like housing, utilities, food, insurance, and minimum debt payments, like I said earlier. So lifestyle spending is dining out, travel, your entertainment, your subscriptions, all that kind of stuff. The things that make life enjoyable but aren't required for survival. When you separate these categories, you gain control. In a jobless or downturn, um, you ins- you instantly know what you can be paused without jeopardizing your stability. And reviewing these categories regularly keeps you grounded. It's not just about restriction. It's about awareness, and awareness create confidence. So lay out all those expenses. I think that's a big thing that a lot of people don't do, where you can see it in front of you. So.
Exactly. And you mentioned that word subscriptions. So that's the slow leak that gets a lot of us.
Mm-hmm.
Audit those subscriptions and those hidden costs. Um, so let's talk about that little sneaky stuff. Subscriptions and recurring charges, streaming services, apps, memberships, software, they add up quietly. And because they're small, they often go unnoticed. This is why we recommend a quarterly subscription audit. Pull up your bank or credit card statements and ask, do I still use this? Do I still value this? You'd be amazed how much cash flow you can free up with just a few cancellations. And here's the thing, these small cuts don't reduce your quality of life, they reduce waste. And that reclaimed cash can go straight into savings, debt reduction, or investing, all of which strengthen your financial resilience.
Mm-hmm. Yeah. Speaking of, of strengthening, you also want to strengthen your career and income resilience in general. Your earning power is one of your greatest assets, and in uncertain markets, kind of strengthening that asset is essential. That what that means is to keep your skills sharp, update your resume, take a course, earn a certification, network, even when you're not in job hunting, and consider diversifying your income, a small consulting project, a freelance gig, a rental property. Even a modest side income can be a powerful buffer in condition change. This isn't about hustling nonstop. It's about resilience. It's about having options. It's about ensuring that one income stream flows, another one can help carry the load. Um, yeah, so that's a big one. I think it's something that I think I even practice in my personal life. So.
Absolutely. Absolutely.
Hmm.
And what would be a discussion about future proofing your finances without talking about taxes since we are in tax season? Um,
Hmm.
so strong markets can lead to capital gains, and capital gains can lead to higher tax bills. That's why periodic tax checkups are so important. Adjust withholdings if needed. Harvest losses when appropriate. Time charitable giving to offset gains. And most importantly, coordinate tax planning with your broader financial strategy. Taxes don't exist in a vacuum. They touch your investments, your retirement planning, your cash flow, your estate planning, everything. A financial professional can help you integrate all of that into one cohesive plan.
Yeah. And a big part of that plan is protecting against risk. So finally, let's talk about risk protection. What could disrupt your finances? Job loss, illness, disability, unexpected repairs, life happens. And the best way to future-proof your finances is to identify those risks, make sure you're protected. And that means having the right insurance. That means having adequate cash reserves. It also means reviewing your coverage annually to make sure it still fits your life. Protection isn't exciting, but it's foundational. It's what keeps a setback from becoming a crisis. So,
That's right. That's why we lead with risk management in our practice.
mhm.
So strong markets are encouraging, but lasting resilience requires more than chasing returns. It requires preparation. It requires adaptability. And it requires taking small, intentional steps that protect the progress you've already made.
Yep. So start with one action. Set up an automatic transfer, make an extra payment on a high interest credit card, audit your subscriptions, map out your essential expenses. Each step you take strengthens your foundation and future proofs your finances. So
Yep. So that's today's Wealth Wisdom Workshop. Thanks for joining us, and we'll see you next time.
Mhm.
Have a great week, everyone.